Okay, good evening everyone and welcome to the Irish 30, and this is part 4 of our financial wellbeing series. So this series was set out to look at well-being in terms of your finances. So over the past couple of sessions, we've looked at budgeting, we've looked at superannuation, we've looked at investments, and tonight we're joined by the lovely Laura Donovan, and we're going to be looking at personal insurance. So the Irish 30 are monthly webinars that look at all aspects of well-being. And this is a sort of micro subsection of that. All of our webinars can be reviewed online at our YouTube channel, and there's some lovely sessions in there if you're just looking for a bit of time out, and they're definitely worth a watch. So before I hand over to you, Laura, I'm just going to acknowledge that I am hosting this webinar from the lands of the Camaragal people. I also acknowledge the traditional custodians of the various lands on which you all work today, and the Aboriginal and Torres Strait Islander people participating and or watching this webinar. So Laura, you're very welcome. Thank you so much for joining us. It's a pleasure now just to be working with Irish people who are involved in the financial industry over here. I know you've been living in Sydney for some time, and you've also worked in the financial industry for some time, so you're a great addition to this series, and very grateful to have you here this evening. So look, I'll hand it over to yourself, and thank you so much.
Hey Una, thanks for the lovely introduction, and thanks for having me on. I was delighted, as I said, to be working with you guys. I know your overall series is around well-being, and you know that I'm a big believer that your financial situation forms a large part of that. By having it all in place, you know, it does bring a lot of peace of mind and security to people. So I think it does play an important part. We'll be talking about insurance mainly today, so personal insurance. We'll run through the main types that you can get, essentially. We'll start with the general advice warning, which is what's showing right now. So that's just to say it is just general advice and general information that we'll be dealing with today. You know, I may give examples which are similar to a person's situation, but it's not to say that it's the right advice for their situation. So always important, if you can, to get this specific advice based on your individual circumstances, because no two people are the same, no two families are the same, and therefore no two needs are the same. If you are going down the path of, you know, setting up any of these products yourself, whenever you're dealing with anyone in financial advice and you're receiving a product, you'll always receive what's called a product disclosure statement or a PDS document. They can be lengthy, they can go on for a bit, but they are important. And I guess if you're going to take out policies, it is important to understand what you're actually covered for. In some instances, there will be situations which insurers won't pay out, which is obviously worst case scenario. If that were to happen, that will be in your product disclosure statement. So if that's a worry for you, and if you're only going to read one page of a PDS, obviously we'd recommend you read all the pages, but always go to that section where it will say, you know, if in this instance we won't pay out for whatever reason. Okay. And it will also go through all your benefits as well that you get for that. So starting off, so I guess some of the misconceptions that we talked about when it comes to insurance. So a lot of people think that, you know, you need a large income, you need a lot of assets, such as a property portfolio, before you need to start worrying about the expense of insurance. The opposite I've found, you know, since working in the industry, it's actually the opposite is quite often true. So when you're younger and you've got, even if you don't have any assets, even if you don't have any property, as long as you're earning an income, you are the asset. So you as a 35-year-old earning $100,000 a year, and you're going to work, we'll say until you're 65, another 35 years, that's $3.5 million.
Mm-hmm.
So, you know, it's not that you're going to get all of that today by any means. Obviously, it is spread out over 35 years. But if that's one asset, then that's a really important asset to be insuring when you're younger. That was one of the first insurances that myself and my partner took out before we had, you know, children, and had to add a bit more insurance into the mix. Insuring our incomes was one of the first ones that we had. And then as you become older, so insurance does become more expensive as you become older. And we'll talk about the different levers that you can pull to manage that over time. But essentially, the general idea is that as you become older, in an ideal world, you'll be building your wealth. So you'll be self-insuring, with the idea being that once you get all the way to 65 or whatever your retirement age is, you actually don't need insurance anymore. So you're fully self-insured. But along the way, as you are running with it, you're trying to always balance. You know, that's what I do for my clients. I balance what they need versus what it's costing. And we have those conversations pretty much every year, basically. A lot of the times it won't change for many years. You know, big things like getting a mortgage tends to only happen, you know, 1 to kind of 2 or 3 times in people's lifetimes. Other than that, it will stay pretty much the same, but there will be items that you still need to review every year. The policies that we'll be covering today will be life, total and permanent disability, income protection, and child critical illness. So we'll run through all of those in a couple of minutes. Before we get to that, we wanted to just briefly touch on general insurance. Now, this is not my speciality. I don't recommend it, but it's an important part of, again, that holistic view of your situation. You don't want one area to be really well covered and then another area to be not covered at all, which can still, you know, essentially have a detrimental impact on your life. So one of the insurance policies that would look at that would be, if you're a homeowner, you'd have home and contents cover. So obviously, you know, great to have all these other covers that we talk about. But if you own a house for several $1 million and it burns down and you don't have home insurance cover, then obviously that's not a great position to be in either. So you really need to be looking at all the pieces and how they get put together. Often when people aren't homeowners, if they're just renting, they won't bother with this type of insurance, but actually you can still get it. So what I have is contents only cover. So that covers the contents in our home. So if anything were to happen to the house, even though we don't own it, all of the contents inside the house will be covered. So things like engagement rings or wedding rings can be covered under that. All your furniture costs. So usually, you know, you get up to around about 50,000 of cover, just as a base. And again, it's just, you hope that these things are never going to come to pass, that you need them. But for a reasonable premium, you can usually get them in place as well. Then you've got your car insurance, which most people are aware of. So you've obviously got your kind of couple of tiers of that, your third party versus your comprehensive cover. When you are getting the comprehensive cover, a couple of things which I always look at is it will ask you to put in either your specified value or whether you want to insure it for the market cost. So they'll give you the market cost. Now, if your car is worth on the market 22,000, but you think that you could replace it and be happy with the vehicle for 18,000, say, and it's going to save you premiums and you're comfortable with that number, then sometimes that's a good lever to pull to reduce the premium, because you really just want to protect yourself against worst case scenario. Something else which I always do, which a client actually told me years ago, was to always use the maximum excess when possible. So with these policies, different insurers will have a different excess. Some of them will be, say, around $5,000 or $4,000. That means that you will pay, should anything happen, up to the 5,000. But above that, the insurer will actually pay you. So again, they look at statistics and say, most claims will be under 5,000. So we're going to charge you more. You go over 5,000, which for me would be, more worst case scenarios type, where you need to actually replace the whole car, then you can really bring down that premium as well. So there's just a couple of tips that I've picked up over the years. Again, health insurance, looking at your basic policies versus your benefits, carrying out a market comparison, and the work cover. So just looking at, this is usually one that's offered to employees on sites, etc. So yes, it can be good to have, particularly if you work in a dangerous work environment. It's not always easy to get other insurances, but don't just assume that whatever that cover is applying to your situation, that it's enough, because there'll also be things that happen obviously outside of the workforce. There'll be illnesses that have nothing to do with the workforce. So you want to be protected for those situations as well.
Yeah.
Okay. Does that all make sense so far? Any questions?
With the work cover, Laura, do a lot of employers, as a benefit to their employees, offer it as like an add-on to their package?
So some of the more highly skilled or the more professionals will offer income protection. So like solicitors sometimes will get that income protection package. But that's more on the income protection side of things. The workforce cover is a more basic cover, which basically is just protecting you against accidents that can happen on site.
Okay.
But when you've got things like your income protection, and it's protecting you against things that happen on site, plus illnesses that happen off site and all the rest of it, then obviously, it's a lot more comprehensive. So it's just balancing between the two. You might be happy to say, as long as I'm covered on site, I'll run the risk of an illness. But ideally, you'd be looking at having some degree of protection for both.
Okay.
Okay. So these are this is an overview of kind of most of the personal insurance that advisors would deal with. So you've got your life cover. So on the left-hand side, these are your lump sum covers. So that means that generally they will just pay you out an amount, and we'll talk about how they get structured in a while. But the lump sum cover, so life cover, provides a benefit in the event of death or terminal illness. You've got TPD cover, which provides a benefit in the event of total and permanent disability. So it's essentially if you're unable to ever work again. And then you've got trauma cover, which is a benefit paid in the event of serious illness or injury. Now the difference with that one is you just tick a box essentially of whether you've met the illness essentially. So the most common reason that people claim on that trauma cover is for cancer. It doesn't necessarily matter if you've had time off for the cancer or if you've had to have operations. It doesn't necessarily matter what your treatment schedule is. So I've seen clients who've had trauma cover, have had cancer, have luckily never missed a day of work, and they've managed to get a trauma payout of several $100,000 or whatever their policy may be for. So with the other policies, it's generally very much how sick are you essentially. That's what it comes down to, lots of doctors' reports and seeing, how things are tracking. The trauma cover is a bit more straightforward than that. But it does have a very definitive list of what you can claim for. And you're kind of confined to that list.
Well, it's quite reassuring to know that that's how it works, because I would assume that, for anyone who is in that situation where they've had a diagnosis, they really don't want to be disputing claims and, are, trying to get cover, from an insurance company. So,
yeah.
And do you have to, I know you'll talk in detail about it later, but I'm assuming you have to have that cover for a certain period of time for your diagnosis.
Yeah, so generally with all insurances anyway, how I talked about in the product disclosure statement, it would say when we do not pay. So one of the situations where they won't pay is when there's an initial waiting period. So it's usually between 3 and 6 months. So it's not an overly long period. It's not, a year or 2 years or anything. But there is always an initial waiting period, which I think is pretty common across most policies.
Okay.
In the middle column, we've got our monthly benefits. So that's your income secure cover, which is the main one we'll focus on today. That provides your replacement income. So it's monthly because it pays you monthly. So what we're talking about here is how the benefit is paid to you more than anything else. You've also got your more specialist cover, so your business expense cover for business owners, and then your living expenses. So they are more in relation to business owners. And then you've got your optional extras. So one of the ones that we will touch on as well today is the child cover, which is available for children aged 2 to 15. It's generally attached to one of the other policies on the left that we've talked about. The amount of cover that you can get is usually between 10,000 and 200,000. And we'll talk in a little while as well about what and how you actually claim on that.
Okay.
There's some other extra covers there, but they're generally dependent on the insurer, so we won't spend too much time on them. So life insurance is probably one of the most common. So you basically get paid a lump sum, or you can choose to get it paid in installments if you die or you're diagnosed with a terminal illness. So sometimes that diagnosis needs to be that you are terminally ill and won't survive 12 months. Sometimes it's 2 years. Insurers have probably come under a bit of pressure in recent years to be a bit more flexible with that feature, because obviously it's not always clear when someone receives that terminal illness diagnosis how long they have. And as you said, the last thing you want to be doing in that situation is arguing about something which is largely an unknown as to whether you've got 12 months to live or 24 months to live. You really just want to get the money paid out. You want it to do whatever you set it up to do, and you want to just be able to move on with whatever time you have left with your family, etc., without having to get caught up in arguments around that. So you can choose the amount of cover that you want, and it's more suitable for families who require cover for living expenses, also mortgages, children's education. There's loads of things that we take into account for this one. This is one of the ones that, for me personally, I didn't have it until I had my daughter. We took out insurance policies then at that stage, because it became quite important. I guess you think about what will happen after you, and it becomes a bit more than just being about you. When you have a family, you want to make sure that if you're not there anymore, things are at least financially okay.
Yeah.
There's obviously an emotional situation which would have to be gone through. you can at least know that there would be the security there. So that was one of the ones that we set up, taking into account things like that we would want a house to be bought so that my daughter would have somewhere to live. We would have that security for her. We talked about things like where the house would be so that we could know that the amount of cover that we would have would be enough to meet those needs. And then people can take into account things like, as I said, your children's education. For some people, having, particularly in Australia, I find private education is quite important to a lot of parents. So they'll often include that as well in their needs analysis. That's one of the ones that does tend to go down and change each year, because once your children actually start in the system, you no longer have 8 years of education. You've got, 5 years and 3 years, and then eventually that need is removed. So it's kind of reduces again, as we talked about. You're reducing over time. With the life insurance, it's often held in superannuation. You can receive a tax deduction up to 15% for it. This particular one is not tax deductible if you hold it personally, so if you have it yourself. TPD, so total and permanent disability. So this is one where the technical features of the policy become quite important. Obviously, life insurance, as they say, it's not really one that you can argue the quality of the policy over, because essentially if you're dead, you're dead. Whereas with TPD, it becomes a lot more of a grey area, because it's essentially that you have to prove that you can never work again.
Okay.
And that's different insurers and different doctors may have different approaches to that. Yes. So this is one where the quality of the policy really comes into play. If you hold this one in super, which again, a lot of people hold it in super and they link it to their life insurance. So when it's linked, it means that your cover is the same usually. So say you have 2 million of life and then you link 2 million of TPD. If while you're alive you claim 1 million on the TPD, your life reduces by 1 million. So you still have 1 million. So you're not doubling up on the cover, because most people don't need both policies. It's usually, a bit of a crossover in your needs. So usually people will have these linked, which reduces the cost of it, but you still know that you're covered in both instances. Again, it's, receive a tax deduction up to 15%. It's not tax deductible usually when it's held personally. Any occupation versus own occupation. So when held in super, you can only have any occupation. When you hold it personally, you can have own occupation. So the best way to explain that is with that example of own occupation. So if you were a dentist or a surgeon, so quite a specialized field, and if something were to happen to you, say you severely injured your arm or your hands, and you were unable to return to work in that particular role, the last thing you want is an insurer to say, well, you can't do that role, but you can go and work in McDonald's, because that's quite an easy thing to do with, whatever impediment that you might have. So a lot of people won't want to do that, obviously, and they would say, if I can't work in my field, I don't want to work in any field. So if that is the situation that you're in, people will often hold it personally, because then it means that you can have an own occupation policy. It protects you in the role that you're in, but it means that you don't have to worry about being made to work elsewhere in a different industry.
I see. Okay. So Laura, would you say it can be held in super or it can be held personally? Does the are the cost of premiums more expensive personally?
Usually only from a tax perspective, because and there's a slide in a minute which goes through cost in super, cost outside super. But generally speaking, where if you hold the exact same policy, inside super and outside super, it won't cost you any different.
Okay.
But most people hold it outside super for a specific reason. So
Okay.
obviously your own occupation policy, it's more specific, it's a better quality, so you're going to pay more for that.
Yeah.
So it's not necessarily the fact that you're holding it personally, it's more that you're changing the quality and therefore it's going to cost you more.
Of course. Okay.
So income protection. So this is one, as I mentioned earlier, I would probably say to most, young people, as in people who are working, may not necessarily have dependents or children to worry about, may not necessarily have a mortgage to worry about. If you would only have one insurance in that instance, income protection is usually the one that I would recommend, because as we talked about, your income being worth millions basically over the lifetime that you're in the workforce. It is quite a comprehensive cover. It is based on your income. So with the life and TPD that we talked about and trauma cover, you can, within reason, there's minimums and maximums, but you can generally say, this is what I need and this is what I want to apply for. Income protection is different in the sense that you are insuring what you earn.
Mm-hmm.
So you can only insure, generally, again, there's all different tiers to it, but generally speaking, you insure 75% of your income. So if you earn $100,000 a year and you're out of work, most policies would pay you $75,000 a year. Some of them might pay you a bit more and pay a bit more into your super, etc. But again, it comes down to what are the little policy features that you want to add, which are within your budget. The benefits are based on the time that you're out of work. So again, we're talking about an insurer really looking at your situation and saying, do you meet the criteria? So one of the important criteria is your waiting period. So it's usually 4 weeks, 12 weeks, or 2 years. So something which Kieran actually touched on in an earlier presentation was around, I think it was the budgeting one, saying try and have 3 months basically cash in the bank. So you have 3 months living expenses. So that's kind of a general rule of thumb for everyone. I think it's a great one to go by. Where it actually helps in this instance is if you have a waiting period of 4 weeks on a policy, what that means is that you're out of work for 4 weeks. On the last day of the 4th week, you put in your application and then you're waiting however many weeks for the benefit to hopefully come through. Mm-hmm. If you can move that waiting period from 4 weeks to 12 weeks, which doesn't sound like a huge amount, but it is meaning that, if you need $1,000 a week for living expenses, it means that you go from needing $4,000 in the bank to $12,000 in the bank. If you can make that shift, and going back to the self-insuring, if you can do that for 12 weeks, you generally bring your premium down massively. Reason being, people who are out of work for 4 weeks versus people who are out of work for 12 weeks, 3 whole months, it's actually statistically a lot lower for that to happen.
Right.
So insurers are just all about statistics. That's all they want to know is how likely are you to claim on this policy? The less likely you are to claim, the less we will charge you, and vice versa. So again, it goes for the, you can have a waiting period out to 2 years. Sometimes you'll have insurance in super, which might pay you for 2 years, and then we'll often tack on a second policy, which would pay you from 2 years to age 65. So you kind of slot them together. It is important to note you can't get paid out on more than one policy. So if you earn 100,000 and you have 3 policies and you're paying for 3 policies, which with the intention that they'll all pay you 75,000, they won't. So your whole situation, you can only get 75%. So this is important to not have stray policies here, there, and everywhere, because different to life. If you had several life policies, they will generally all pay you. That's not the case with income protection.
And would it be common for people to have multiple policies?
So you could, if you were mostly in super funds.
Okay.
Usually people wouldn't when they're paying them personally, because we're a lot more aware
Yeah.
of what's going out of the bank account rather than what's going out of our super funds, just because we're all a bit detached from it, I guess. That's what we've seen. So it's generally, if you have a couple within super, that'd be the most common.
Okay.
One of the other differences with different income protection policies, you could get an agreed policy, as it was known. So this would be one of the reasons that you would have held it personally, because you would basically apply, and if you earned 120, 150, it didn't matter. You applied today, you were earning that money today, the insurer assessed you today, and they issued you your policy. And then if the next day you left your corporate job and said, you know, I'm now going to pursue my dream of setting up a business and selling candles or whatever it may be, and then you earn 40,000 for the next 5 years or 50,000, and then you need to claim, you can actually still claim 75% of what you were earning at the time that your application went through. So that was a fantastic policy to have. The insurance world and insurance companies have actually gone through a huge amount of change in the last few years. So they're finding it difficult to continue to pay, basically, because claims are just on the rise constantly. You know, mental health is declining all the time. So mental health is a huge reason that people claim on their income protection policies. So insurers are trying to keep up with all of this change. And as part of that, they actually have stopped issuing agreed policies now. But if you have had one set up before kind of the last 12 months, very important not to let that go or cancel it without understanding that if your salary is going to change in future, you may not get that again. Because now what most policies are is indemnity. An insurer will basically look at the best 12 months of the last 3 years. They might look at an average of 3 years. They might look at 5 years, but it's not guaranteed. It's not what you earned when you applied, so it's different. The premiums with income protection can be claimed as a tax deduction in super and personally. So generally, what people earn, so your marginal tax rate, what you pay your tax rate on, will be more than the tax deduction that you get in super, which is 15%. There's another slide for reference, which people can check in on, and you can see what it looks like when you hold it personally in super, or if you held it in super and made additional contributions to offset the premium, so that you know your balance isn't going backwards. I'll often get asked if redundancy is covered for income protection, so I would often get phone calls and say, I've been made redundant, can I claim on my policy? Just to note, it's generally not covered, so redundancy is a separate issue, which sometimes you can get cover for, but for general income protection policies, that's not the purpose of it. It is for illness or injury.
What about situations, Laura, like the pandemic and people losing their jobs because of the pandemic? Would they be covered?
Yeah, so not as a general rule, no, because it's not an illness or injury. Now, if you got COVID and were out of work, then that's an illness. And if you were in hospital, etc. So then again, it just comes back to your waiting period. If you're out of work for 4 weeks plus, you go and claim on that basis. But it's interesting because when we talked about the kind of overarching rules where insurers won't pay, so you know, one of them being, you know, you have to have had the policy for 3 to 6 months. Product disclosure statements have actually updated over time to take into account what's going on in the world. So another situation where most insurers won't pay is if you have if you've lost your life, or if you've, suffered a TPD event because of an instance of war. So if it was as a result of war, you actually don't get paid out. Then it was actually updated to include that war and then specifically terrorism, like when we saw a lot of terrorist activities coming into play more in the Western world in the last few years. So that's also included. And I believe now that some of them are moving towards that, possibly having more specific wording around the pandemic as well included. But I don't think they can exclude you if it's as a result of the illness. But I know that there are a lot of insurers, like I guess travel insurers now would be a lot more wary about including wording around, specific events such as pandemics.
That seems quite harsh that they wouldn't do a payout for acts of terrorism.
Yeah, and I think actually I read something a few years ago where I think it was off the back of one of the terrorist attacks in London, and how there had been a pushback from it, and they actually didn't want the government to classify it as a terrorist incident because they wanted it classed as an accident, because the families of the victims essentially couldn't claim on the cover. So it was quite interesting, and definitely, obviously we're quite protected from all of that, but it was just in the last kind of 5-10 years, that conversation has become a lot more important. I think people will be a bit taken back to know that. Absolutely. But yeah, most insurers won't. Yeah.
Wow. Okay.
So then that's the income protection. The last one then is the critical illness cover, which you can also have the child cover attached. So this is also known as trauma cover. So again, it's that one-off payout that we talked about. Most policies, as I said, are quite specific. Here's your list of 40 or 45 conditions. You meet that illness or injury essentially. And, it can be quite clear cut. It's not dependent on time out of work or treatments, etc. It can come down to how advanced it is. So, some people will have stage, very early stages where it's detected before it's almost classified as a cancer. So there can be some instances like that. There can also be partial payouts on trauma cover, which that's what that category will come under. So they might not pay you the whole amount. Like I've had a client where, because it covers heart conditions as well. So I've had a client who's had a blockage removed, for example. So in that instance, not a full, he didn't have a heart attack, but he had a blockage, which would have potentially ended in a heart attack if he hadn't had surgery. So in that instance, we look at whether people can claim for that partial payout, and often insurers will pay 25% or 50% of your total cover.
Okay.
And then the child cover. So, I mean, it's not something, I guess, you kind of get a bit, hardy when it comes down to going through all the numbers of your own situation sometimes, or at least I find I do. But the child cover is always a bit of a particularly sensitive topic. But still, I think, again, it's just another piece of protecting your situation. So what that means is that if your child were to suffer, one of those illnesses that we talked about, so for cancer, for example, and if you've got your cover and, your husband, your partner, whoever also has all of their cover and their income protection, but all of a sudden it's actually your child that is seriously sick and needs your time out of work, and the medical costs that come with that. This is where the child cover can kick into play. So you can usually insure between 10,000 and 200,000 depending on the insurer, and you basically attach it. So you can't usually take out this cover on its own. It needs to be attached to one of the other policies that we've talked about. It can't be held in super, and there's no tax deductions for it.
Okay.
So how much do you need? So I guess when people are maybe looking through this, they might just want to know how to work out their own situation. So I tried to put through down here, you know, our list of what we go through, it's not a very comprehensive list. There'll always be one-off items that people will need to get taken into account. But one of the other misconceptions that we wanted to touch on was, as I talked about with the insurance industry, it is struggling. It's a struggling industry, and that's why it's gone through so much change in the last few years. People have, as I said, that misconception that they just want to give you all this insurance, like take the insurance, we'll take your money, and then when you go to claim, you're not going to get any money out of us. Now, that's not to say that there are no insurance companies out there like that, but generally for the ones that we're dealing with, or that most advisors deal with, because it's not a retail policy, so it's not, you know, like ones that you see on TV where you just ring up and say, this is my name and date of birth, and this is my credit card number, and they go, no problem, you can have, you know, 5 million worth of life insurance, and then it comes time to claim. And if, for example, you've died of a heart attack and you've had heart issues your whole life, in that instance, then the insurer will turn around and most likely not pay your family anything because it was a pre-existing condition. The best type of cover will be usually the most time consuming to set up, because they'll go through all of those questions up front. So they'll ask you your medical history, they'll want to know about pre-existing conditions, and then at least when you take out the policy, you understand what you're actually covered for, rather than your family finding out after the fact. Plus, you've already spent all the money, you never get that money back. The onus is on you always at the end of the day as the client to understand what you're covered for and to let them know if things change. Sometimes it won't affect your policy, but you know, when people say, oh, well, the insurance company should have told me, or you know, this wasn't clear, etc., 9 times out of 10 you won't have any comeback. You know, the responsibility does lie with you, or you know, your advisor, I guess, to keep you educated on that point. So back to needs analysis. So when we're looking through, you know, a client's needs analysis and going through what exactly they need, because people will often get caught up on how much things will cost. Before you worry about what things cost, you need to know what you need. If you need it and can't afford it, then you can start taking things out or prioritizing what you need. But yeah, I would always say to clients, you know, don't come in fixed on, this is how much I want to spend in a policy, what can I get for it? It's not the best approach to have. You know, the best approach is to say, this is what I need, this is what I really need, if I can't afford that, and work it from there. So the common items, so we generally divide needs into lump sum needs and income needs. So lump sum needs are things like one-off. So clear a mortgage, $1 million. So you go lump sum need. 3-month savings, $12,000. Lump sum need, funeral fund, you know, 15, 20,000, emergency fund, 20,000, things like that. You know, mortgage on the home, you might do it in full, you might just do 50%. If your partner is, you know, the main income earner, for example, and you're not really concerned about how they're going to pay the mortgage without you, and you want to maybe decrease the premiums a bit, some will just factor in 50% of the mortgage. Some people will include mortgage on investment properties. Some will say, if I'm not here, you know, my wife, my husband, whoever can just sell the investment property and clear the debt. We don't need that cover. It's extra cover. So, you know, it might be nice to have, but if it comes to it, that's what we're comfortable to base it on. Your spouse's income needs. So this is, you know, if you are the income earner and your income is enough to meet living expenses, you don't always need this spouse's income needs. The reality is, even if you're the income earner, if your spouse isn't there anymore, so often, you know, women tend to be primary caregivers, obviously. So when they're at home, you know, sometimes people might say, well, I'm the main income earner, wife stays at home, so we don't necessarily need to cover an income need for her. Reality is, if your wife is not there anymore, and if you have this job where you need to be fully present and earning this income, there's a cost there, because while your wife might do the job for free, nobody else is going to. So that comes down to, you know, all the additional care that you need in that situation, whether it be nanny, housekeeper, you know. If it's TPD, you also need to factor in all these medical expenses, which haven't been there before. So it's not just your regular living expenses that you need anymore, it's also all these medical expenses that you need to take into account. Then you've also got your children's income needs. So we talked about that earlier with the private education, for example. You basically just go education costs by number of years. So if it's like Catholic school, it might be 8,000 by, you know, however many years that your children have left in school. Funeral and legal expenses, so that's lump sum again. Medical expenses for TPD, so that can be either, because you can have 200,000 to say, if I'm TPD, we're going to renovate the house because, you know, often it would be the case that you'll be in a wheelchair, for example, and your home is inaccessible for that. So you need to actually change the whole structure of your house just to make it livable for you. So that can be a huge task. So sometimes, you know, we'll do lump sum for that, plus income needs, because you also have an ongoing income need if you're TPD, generally speaking.
Yes.
Emergency funds, so that's a personal preference. You know, some people might just say, just have extra 20,000 there, a bit of a buffer. Including or excluding existing assets, so superannuation, you could say, I don't want to touch my, you know, I don't want to include the super, I just want that to be extra for my spouse if I'm not there anymore. Investment properties, again, you can include them or exclude them, you know, as we talked about, which is selling them. The income protection, that's, as we said, not really how much you need, it's more set on what your income is. But if you do earn lower and are insured for higher, as we said, you won't get a refund of the premiums, and you also will not get the higher benefit payout. So if you were insured for 200,000 and then for 3 years you earned 70, and then you went to claim and they would only pay you for 70, you will not get a refund for all the time that you were paying for a salary of 200,000 to be covered. So again, important to know what you have currently, making sure you keep a track of it, and just knowing that it's still fitting to your situation. You can also have income protection, which can lower your TPD needs, because, you know, the TPD is, as we said, you'll have your lump sum, but then you'll also have your income needs. So what it will often be will be whatever those income needs are, less what the income protection will pay you. So it can bring down that TPD need quite dramatically.
Okay. Laura, I'll just ask you quickly, because I know time is sort of...
Yeah, I know time is going on.
Just quickly, is there a separate mortgage insurance, or is the mortgage payment, would that be within the life insurance?
So you can get mortgage insurance as a separate product, as far as I know, which comes under the general insurance.
Okay.
I know they actually require you to have it in Ireland as a separate product.
Yeah.
Also here you get like a lender's mortgage insurance, it's called, which can be very expensive if you don't have your 20% deposit. That's, you know, that's a bit more of a, you don't pay back your loan, basically. They have this backup for you. So, you know, it's very unlikely that you would ever need that LMI cover, as it's called here.
Yes.
With the life insurance, it's a bit more, it's your decision. You're incorporating it into your life cover, as opposed to a specific mortgage product, which will just match your mortgage amount usually.
Okay, great.
And we'll get moving through this quickly. Just conscious of time. So the ways in which it can be structured. So we've touched on this already. You can have it inside super or outside super. It's very important to understand the differences. So when you are holding it inside super, the process is you apply for your benefit. It gets accepted or rejected. We assume it gets accepted. It then gets paid to your superannuation. So it doesn't get paid to you. So it gets paid to your superannuation. Every superannuation fund has a trustee of that fund. The super fund trustee then decides whether you personally get the money. So there is that extra step. So as you can imagine, this can cause complexities along the way because you've got different criteria a lot of the time. Now it's a lot more aligned these days because it's pretty basic, the cover that you have in super, which means that it's more aligned with the SIS Act, which is the Superannuation Act, which says how money can be paid out of super. So since 2014, they changed the criteria. So it's pretty similar these days. So it's less likely that your money would get trapped in super, but it has happened in the past and it is something to be aware of. You've got two benchmarks to meet basically. So you don't just have to, when you hold it personally, you apply to the insurer, they say yes or no. You've got two of those hoops to jump through when it's held in super. And then stepped and level. So this is something which affects the premiums quite a lot. So if you have a stepped policy, and it's an option which most of the time you can take, whether you choose stepped or level. Usually having a stepped policy will be a lot cheaper because again, it's the statistics of at what age you're going to claim on this policy. So while you're young, insurers don't necessarily think you're going to need it anytime soon, so they won't charge you as much. Each year as you age, the policy gets more expensive. Versus levels, you can take out a level policy early, you will pay more, but it won't recalculate by your age every year. So level covers historically have been great to have, take them out young and keep them, and then just increase by CPI. But again, with the industry changes that have been happening, they're not guaranteed anymore. So we've seen rate rises across the whole industry, across occupations, and even level policies have gone up in a lot of instances to try and keep up, as I said, with the struggling industry. So it's not a guarantee that your policy will never go up, but it's more secure than a stepped policy.
Right.
We won't run through this, but look, it's there for reference. It's basically if you had a salary of 70,000 and you took out life and TPD cover, the amount doesn't matter. All that matters is the premium. If the premium costs you 1,000, you get a tax deduction of 15%. Net cost is 850. If you hold it in super, you get your tax deduction in super, plus you get your tax deduction for making a contribution. So that's that middle line. So you get basically 2 rounds of concessions, which means that the net cost is just over $512. And then it goes the same for your income protection. So you can really see with the income protection how beneficial it is if you're a high income earner. So if you go down to the last row, personally held, and you're on a marginal tax rate of 45%, your premium is $2,000. Tax deduction is $900 because it's that 45%. So the net cost is just $1,100. So that's a pretty good deal if you can afford to hold these policies personally. Most of the time with the income protection, it would be better to hold it personally because of the tax benefits that are available.
Absolutely.
So we'll just run through this quickly. So understanding how much you need, what types of cover are relevant. Once you've decided on that, you consider the ownership structures which are most appropriate, how much premiums you can afford. Then you go through what's known as an underwriting process. So as I said, If there's no underwriting process, please beware, because the insurer does not know the risk that it's taking on. If they don't know the risk, there's a chance that they won't pay when it comes time to claim. Once the policy has been issued, it is a guaranteed policy, so you hold on to that policy schedule which you were issued. It's a very important legal document. You can get it replaced, but it's not as straightforward as just requesting a statement, for example. So make sure and file it. You'll generally get a hard copy of it, put it away. If you do lose it, insurers will generally just get you to sign a static to replace it, etc. But it is important, I guess, to keep it on file, read it, and know what you're covered for.
Okay.
Issues that can affect the premium. So smoker versus non-smoker, huge impact on the premium. Again, obviously, because of the health implications that come with smoking. It's not just expensive to smoke, it's also very expensive to be a smoker with an insurance policy, whether you're male or female. So interestingly, most people know that statistically women outlive men. That's the case through all our lives, basically. So because of that reason, life insurance is more expensive for males, a lot more expensive for males than it is for females, because statistically they're more likely to need it. On the other hand, income protection is a lot more expensive for females than it is for males, because they're a lot more likely to claim on that one. Obviously, there's nothing that you can do about that. Well, I guess for the sake of the premiums. So it's just something to be aware of. It can affect the premiums one way or the other. Occupation rating, so whether you're a blue collar worker, whether you work in an office 100% of the time, if you're a CEO earning above a certain amount, all of these things can impact the occupation, because different insurers will have different preferences essentially as to who their clients are. So some will really cater for say those in the mining industry or fly in, fly out workers. Other insurers, it just won't be their cup of tea. So don't be put off if you go to one insurer and you don't get offered any cover. They have their niches, and the industry is moving with that as well. Monthly payments versus annual. So if you can afford it, it's always best to pay annually. You usually get a discount of, you know, up to 8 or 9%. So that's a really easy one to pick up if you can afford it. It's not always, you know, that easy, but if you can, as we talked about, having your 3-month savings sitting there, it's another way to just be making those little small decisions that overall put you in a better decision in the long run. Issues that can affect the premium with your age is obviously, as you get older, it gets more expensive. Stepped versus level, inside super versus outside super, how the advisor is paid. So again, the industry has changed a lot in recent years. I won't go into it in too much detail, but previously insurers could get upfront very large commissions, like 110% of the premium, then it would go down quite considerably. That would impact how much you pay essentially, because clients don't generally pay advisors for insurance advice. They get paid from the insurer. So how the commission is structured impacts the premium. If you are paying no commission to the advisor, which is sometimes the case, and it's probably where the industry is moving, but we're not quite there yet. You can pay no commission, your premium will most likely be lower, but then your advisor would most likely charge you a one-off fee, which people are not always willing to pay either. So most people will just say, yeah, we'll just go with the insurer. But you as the client need to be aware, in that particular instance, the more expensive the premium is, the more the advisor is getting. That's not necessarily a good or a bad thing. It comes down to the quality of the policy. It's just something to be aware of when people are being paid on a commission basis.
Yeah.
Linking policies. So as we talked about, you can link your life insurance with your TPD or TPD and trauma. You can put all them together. Indexation. So if your policy goes up every year, or you want your salary, you want your income protection to go up 3% each year, assuming that you're getting a pay rise of that much. Most people will want to have that on their policy, but obviously it just adds a little bit more to it.
Okay.
So finishing up, we're not doing too badly for time after all, a bit of a race towards the end. So default insurance within super, it's not the greatest quality of policy that you will find, but it is often quite cheap. And if you have other medical issues, don't just discount it. Be aware of, if you can't get better insurance, something is better than nothing. And that's often the case with the default insurance within super. I'm in a couple of expat groups where people are returning to Ireland. And one of the recommendations that always comes up is cancel all your insurance before you leave, because it's you want to be saving on the premiums.
Yeah, well, that was actually a question I was going to ask you, Laura. So especially for people like us who are Irish, from Ireland but living over here, and say for people who don't 100% know whether they're going to spend the rest of their life in Australia, but they still want to invest in insurance to protect themselves. Is there any sort of relationship between insurance companies where, say, I have life insurance here for X amount of years and then I decide to go back to Ireland, that would in some way, like my premiums paid, would be carried over so that that money wouldn't be lost?
So look, you couldn't, as far as I know, you can't carry a policy across. I think with some health insurers you can. If they're a global provider, you can move your health insurance across. But the thing is, with life insurance and TPD, nearly all of it will be in your product disclosure statement. So again, always read the PDS, but most of them, it's worldwide cover. So you actually don't need to cancel your policy and take out a new policy in Ireland.
Oh.
It's worldwide cover, generally speaking. So even, we're expats, so we look at it through that lens, of course. You think whether you'd be paid out while overseas is something that's very important to us. But equally, even if you are just an Australian who's always been here and you want to go on holidays, people will often go overseas. I mean, when you could back in the day, and hopefully again soon, people would often, rush and put a policy in place before they leave, because it's actually more of a risk, believe it or not, to die while overseas. But anyway, we won't get into that. But it's the same situation. If you were an Australian and you died overseas, you would still expect your policy to pay you out. So it's actually the same thing. So, if I was ever to go back to Ireland, I'd probably do a comparison to see what the premiums are like, but I might still just keep my cover here because, I've had it for quite a long time. I know the amount of cover is appropriate. I'm comfortable with the premium.
Yeah.
Yes, it's paid from my super. And if I wasn't here, there wouldn't be money going into my super. But you can easily do that.
Okay.
Most superannuation funds are set up nowadays that you can just put a contribution in and keep that cover going. Okay. So don't ever just disregard it as just another fee, because especially with this default insurance, it's so cheap. And, that $500,000 that they've just given you and charge you, a couple $100 a year, whatever it may be, that could be a huge difference. We're talking TPD, you're unable to ever work again. That $500,000 that you've just cancelled because you want to save on fees, without really giving it that much thought, it can actually, be life-changing, really.
Really interesting to know that. That's good to know. Okay. Mm-hmm.
So some of the other top tips are just, ensure the things you can't afford to replace. Again, this was just something that I was told years ago, and it just kind of stuck with me, because I think you can get caught up in how much should you be insuring, what should you be insuring. Like one time I think I bought a dryer and they were offering me insurance for the dryer for whatever, 20 bucks or something, or 50 bucks. And you kind of think, oh, that's not much, so maybe I should just insure that. But really, the chances are you're not going to need it, first of all. Secondly, it's a small amount, but it's better in your pocket than theirs. And thirdly, if it did break down, worst case scenario, you most of the time will have a couple $100 to replace it. So then that comes back to really just ensuring, if you cannot replace something easily, so you cannot replace your income. Nobody has, very few people have millions in the bank to replace it. So that's why some people don't even have car insurance, because they run the risk and say, well, I have 20 grand in the bank, so if I needed to, it wouldn't be nice, but I could replace it.
Yeah.
And having your maximum excess, because you don't want to pay $4,000 if something goes wrong with your car, but if you had to, you could, if it's going to save you, a couple of hundred in premiums every year, because it's not, chances are it's not going to happen, but if it does, you just want to have the right amount to cover for it. So another rule of thumb: spend approximately 3% of your income on insuring the other 97% plus. Again, just something somebody told me years back. I guess if you're earning 100,000, then you might want to put, say, $3,000 aside for your insurances, just as a general rule of thumb. Have a valid nomination on your super. So if you are holding policies within superannuation, you need to have a binding nomination, which is valid. They can only go to certain people. So generally it's a spouse, somebody who's financially dependent on you, or like one of your children, for example. So there's very few people that you can have a valid nomination to. If you don't have a valid nomination on your super and the money lands into your super and there's a dispute over who it goes to, that can become a very messy situation. Policies having minimum and maximum amounts of cover, we've talked about that. They will expire at certain ages, so don't look at life insurance as something to pass on to your kids. Or people who would say, I've paid all this cover and I've never even gotten paid out on it. If it's life insurance and you're still alive, then that's a pretty good outcome in my books, that you haven't needed it. The goal is get yourself to that stage where you're fully self-insured, and you may look at it as money lost along the way, but it's actually not, because it's brought you security when you couldn't bring it to yourself. When you couldn't fully, protect your financial situation. Insurance, that's what you're buying. You're buying security. You're not buying into, I will get this money, because if you get it, it means that, you've been sick, you've been out of work, or something serious has happened to you. So that's not the win, the situation either. So either way is a win, as I like to look at it. If you want to look at it in a positive, a positive frame of mind, you either never use it and you're healthy and you've never needed it, or you need it along the way and you've managed to get the benefit payout. As we said, most policies will not pay out in the event of self-inflicted acts of suicide, acts of war and terrorism. And again, just wrapping up with, the sufficient cover, just it's the buying of the security really that you're spending your money on. So knowing that your family will be looked after should the worst happen and you pass away in the worst case scenario, or even if it's just for yourself, your income protection, not being in that extremely stressful situation. Particularly, we see it all the time with people who become injured here, or become sick for whatever reason, and then you're so far from home, and I guess a lot of the the usual support structure, and you guys would see this all the time, I guess, that you've got your usual, you know, family that would step in financially or whatever it may be. When you are an expat living in another country, that's not always available to you. So then that's why people often end up needing to do, you know, big like GoFundMe pages, or, you know, the Irish community is great for doing different charitable events to raise for people who have been in that situation. And a lot of the times, you know, if you can afford it, there is insurance there to protect you against most of those things.
So sorry, Laura, there was actually a question that came in, and it just ties into that. So in terms of that, what you were just speaking about for expats, is there a standalone repatriation cover, or, you know, is it all just tied into that sort of
Yeah, look, not as far as I'm aware of. I know there is that repatriation trust, the Kevin Bell one, I believe it's called.
yes,
But as far as I know, I mean, that's the background of that is just, you know, one family who are doing fantastic
yes,
things. But it's, as far as repatriation cover, it would just be something that it would be something that you would include, you know, as a something that you want to cover, but it's not necessarily what is the cost of this. It's just you saying, well, I would like to have, you know,
okay,
20,000 or whatever. Or, you know, if it's not the case that you've passed away, if it's just the case that you've been injured, then it comes down to, you know, more like your income protection. Okay, you've been out of work for 4 weeks. Now we apply for your income protection cover. Or if it's, you know, the cancer or one of those events, then you go to your trauma cover. So there's not a specific, as far as I know, there's not a specific repatriation product, but you would just incorporate it into the things that you want looked after should anything happen to you.
yeah, it's quite an interesting one, because it for some maybe expats who you know, just haven't decided that they're going to get life cover or illness cover, it might be something that they may fall back on, just, you know, because they wouldn't want that cost then you know, being, you know, put onto their family or to anyone else, I suppose.
Yeah. And I guess that's why it's important as well, knowing what's in your super. You know, if you are younger and, you know, you often don't have a lot of excess cash flow, and, you know, you probably as well think you're invincible, as most people do, you know, until a certain point. I think you get a bit more kind of aware of actually something could happen to me. But in that instance, that's why I think it is good with the default insurance. You know, that's quite a different thing that we have here in Australia, where superannuation funds issue you with that default cover. So again, it's not something to be taken for granted. Not always the best policy, but in terms of things really being bad, it can really make a huge difference. And again, it's not something that you're paying for personally, because most of the time the premium is just coming out of your super.
Sorry, I know you've probably mentioned this, but with the critical illness cover, can you put that in super?
No,
No.
not that particular one. Yeah, it is one
Okay.
that you just have to pay yourself. But I mean, so I mean, I ran some quotes. I didn't include any quotes in the presentation because look, it's a moving feast of
Yes.
your age, your needs, insured on any given day. But I guess just to give some level of context. So for a 35-year-old, 2 million of life and TPD, you'd probably be talking between $800 and $1,000 a year. Now, if you hold that in super, you know, you're getting your tax deductions on top of that. If you were to wait 10 years and take it out when you were 45, that would probably double to about $2,000 a year. Trauma cover, which is that one that we've just talked about. So you can have 300,000, just as a figure. 300,000, you can use it as steps, so it's cheaper because you're younger. You can get that for like $800 a year. You know, you can pay it monthly, so it could be less than $100 a month for that
Yes.
type of cover. You might need 300,000, you could have 100,000, and it just means that it's a level of flexibility that you don't otherwise have.
Okay.
Your income protection, $100,000 salary, 30-day wait, so the shortest wait that you can get, would pay you all the way out to age 65. You could get that for $150 a month.
Right. So say for anyone who is an expat over here and heaven forbid they find themselves diagnosed with a critical illness and they want to return to Ireland to be with their family, and that's where they want to receive their treatment.
Mm-hmm.
The cover that they could get would be the critical illness cover.
Mm-hmm.
Yeah.
So you would get your critical illness, and you can use that money whatever way you wish, obviously. Same even if you were to, even for Australians that want other options, you don't always get the best. We've got an amazing system in Australia for healthcare, but if you did want to think outside the box, you might want to look overseas for treatment. That's often a reason that people will have that critical illness cover as well. But yeah, definitely for expats, you could have that, which means that, you've got 100,000, as you said, which means that you get paid that out. You go back to Ireland if that's what you want to do. You're not in dire straits financially because you do have a bit of a backup. If you also had income protection, then you would also, after a month or 3 months, whatever it would be, you'd start getting paid your 75% of your income.
Mm-hmm.
So with the global factor, with the income protection, it is just to note, you will often need to get signed off by a doctor in Australia. So what you could do sometimes is get signed off, go through your application process in Australia, and then you might need ongoing reports where you may run into some difficulties there. So if you were back in Ireland, for example, you'd need to be liaising with the insurance company in Australia and making sure that they continue to pay, because it is more of it's continually assessed. Whereas obviously the life, the TPD and the trauma, they're assessed and they're paid. Mm-hmm. Whereas your income protection is an ongoing payment, so your assessment is ongoing.
Mm-hmm. Well, now, Laura, there's plenty in that.
I know we went on a little bit. It's always a worry that there won't be enough to say, but honestly, once you start getting into it, there's just so many different factors to take into account.
But I mean, it is certainly opened up my eyes now to it. And I think it does come all back to that sense of financial well-being, that a lot of people, when they hear insurance, they think, oh my God, how much is this going to cost me? Really, it's about having that sense of security. You don't, that it takes the worry element out of it. And, you can start off, as you said, with your absolute needs, and then you can look at what else you might need to add to it, it's a period of time. But it is just about that sense of security. So I think my takeaway from it certainly is to just start looking into it a bit more and, educate myself and I suppose for anyone else out there, just ask the questions about, okay, well, and get a realistic picture as to what it's going to cost you versus, the security or the benefits that it could potentially bring to you. So, look, thank you so much for really bringing a difficult topic to the spotlight, and hopefully that will have given people something to think about, certainly. And the presentation itself will be shared as well as the recording, so there's definitely a great resource there for anyone who wants to review anything. Fantastic. I mean, there was a lot of information there, and it was just lovely. So thank you so much. Yeah, thanks, Laura.
Thanks, Jane, for having me. I will hopefully be in touch again soon anyway with some more updates.
Absolutely.
Yeah.